Good morning, traders and investors. My name is Roger Scott, and today is Thursday, July 21st, 2022. It's about 8:18 in the morning, and I'm the senior strategist of Wealth Press. At least that's what I was last time I checked. I'm also the senior troublemaker around here. Don't think twice. Folks, NASDAQ is up about 25 points before the opening. The Dow's down about 74 points. And the S&P's meeting us in between. We've had a couple of really strong days. Earnings have been doing pretty good so far. They've been kind of mixed, but don't expect this type of momentum to continue, and I'll get into that more today. But I think we're going to have a little breather. We do need a little breather, which is one of the reasons why I've been kind of slow to put on new positions. I think the market is just a little bit overextended in the short term. I think we're going to pull back a little bit. Not a lot, just a little pullback before we take on to the next level of earnings. But we do need a little breather, as I'll be talking about in today's report. Now, we've got two reports on the docket coming out in about 11 minutes. So you're going to get this data after the fact. We've got the Philadelphia Fed Manufacturing Index. We want a report that does not have a negative in front of it. The last report we had was negative 3.3, and that was the first time we had a negative report, negative reading since 2008. Yes, since 2008. So I'm looking for this report to be positive. As a matter of fact, I don't care what it is. 0.4 consensus is fine. Just anything that's not negative, and I'll be good to go. The other report we have is the jobless claims, and the jobless claims have been near historic lows. I know you'll hear, if they're up a little bit, you'll hear news, oh, they're above the moving average. But the bottom line is, if they're near the 4-week moving average, it's not that bad. It's all good to go. Even if they go up a little bit, they go down a little bit. This is not a bad sign. Again, they're moving a little higher, but 235,000, that's near lows. So I wouldn't worry too much about it. Matter of fact, I think with all of this inflation talk and recession talk, I think more people are going to be getting jobs. So I'm not looking at that as a big issue. The bond market, which has been giving the stocks its directions for the last 2.5 months, still remains in a channel. And I believe this is going to lower volatility throughout stocks. When markets go down, this is interest rates going higher. This is interest rates staying steady. Now, I do think we're going to go lower, which means interest rates are going to go higher. But I think we're going to go lower when the market has the potential to withstand those rates. I think we're going to be in a choppy wait and see mode for quite some time. And the bond market is already well anticipating several 0.75 rate hikes this year. I think 3 more. So I wouldn't expect anything to happen here unless there's something unforeseeable. So if the Fed lightens up, if they go 0.5, say, I don't know why they would, but if they would, this would rally and it would cause stocks to rally as well. If this goes down, it'll put more pressure on tech stocks. And one of the reasons why tech stocks have not been going down is because of the bond market and because there's been less pressure on them as a result of that. And I'll talk a little bit more about that. Volatility levels. Now, volatility is now at the 200-day moving average. This is a daily chart. And we're short volatility. I'm hoping we're going to see a little breakaway here to the downside, but if the market picks up a little bit, cools off a little bit, it'll probably go back up. It'll be very interesting to see this break below the 200-day line. We've been holding this since right here. So we've been going with this all the way. We have a put on volatility. It's down like 25, 30% right now. It still has like 25 days to go. But nonetheless, I want to see if it breaks below the 200-day. So one of the factors you want to look at today, even if the market goes against us just a little bit, if whether or not volatility breaks lower. If volatility can break lower, it could be really positive for the stock market, as I will show you why right now. If you look at the S&P 500, and we'll go deeper into this, we are right now at very, very crucial levels, as you can see right here. See, this is the sell-off we had when the CPI was 8.6. The market said, to hell with it, we're going down. Volatility did not make a new low here, though. That was a big sign we were going to go sideways, which we did. Now, we look like we're going to go higher. So if we can break above yesterday's high, which was at 396.32, I would just say 397, there's a good chance we're going to go back to the base. And matter of fact, a lot of the tech stocks, a lot of the consumer stocks, which I'll show you in a second right here, they're nicely on their way to this level. If we can break above this level, that means the market has already assimilated higher inflation and the worst may be behind us because core CPI peaked 3 months ago. So it seems right now, unless next month's number is worse. And also look at XLK. So things are looking good and things are breaking up. But my question is, are we going to go higher right away and break into the 143 level on tech? Or are we going to kind of come back into the range? Based on the volatility on momentum levels, let me look at the 5-day RSI. It looks like it's too much too fast. And it looks like we could be cooling off at these levels, at least for a few days. So don't be surprised if we go back into this range and if tech stocks cool off, especially with earnings on Tesla, which is up pretty good, up 2.88%, but it's still in the range. We've got Netflix. You'll notice a lot of tech stocks, a lot of consumer discretionary stocks have been in this range, have been in this channel that you're seeing right here. So notice it's coming up. But the question is it going to come up enough? Because it's already down for the day. Earnings were just yesterday and they weren't all that great. So again, I'm very, very cautious and concerned about tech right now, especially after the run-up we've had the last few days. And I'll talk about more about tech when I do my sector analysis in just a few minutes. Now, and remember, today's Thursday. What do I always do Thursday? I give you my top ETF and option pick. Don't be silly. I didn't forget about you. Shares opened lower in Europe. Oil prices tanked on Thursday. Prime Minister Mario Draghi resigned following a boycott of a confidence vote. I don't know. I thought he was doing a pretty reasonable job. More uncertainty for Italy and Europe as a whole at a time when region is forecast to fall into a recession thanks to energy shortage and the war in Ukraine. European central banks was expected to announce interest rate hikes on Thursday, first time in 11 years. I don't know if they did. This might have been, but I don't think they did actually. I didn't see anything about it. I'll have to look at that later. The Bank of Japan indicated they're doing nothing. Japan reported its trade deficit for the first half of the year totaled 8 trillion yen, $58 billion, pushed higher by surging oil prices and weaker yen. They've suffered years of stagnation, and they're going to let the country just go into a natural deflation mode. They think it may just happen naturally. We'll see. A midweek rally driven by strong corporate earnings appeared to be losing steam in the U.S. stocks. That's what I'm telling you guys right now, which is why I went short yesterday. A couple of financial stocks. And I went long healthcare stocks, which is a defensive stock. On Wednesday, Wall Street ended with gains as investors welcome another batch of encouraging profit reports from U.S. companies. And I'll update you guys in my VIP room today on earnings. But I got you guys covered. Here's what's on the docket today. Alaskan Airlines, American Airlines, look for the airlines as a whole. Don't hold your breath. I'm not expecting anything great. We've got AT&T. I think AT&T will outperform expectations. I want to see D.H. Horton, and I want to get a report on them on what's been going on the last quarter, and if if they're picking up construction and if they're pricing in the current downdraft. The PE ratio, folks, on these home builders has been amazing. Then we've got Domino's Pizza. This will be very interesting to see if people are ordering pizza again at night or they're slowing down. If they're ordering pizza, then consumer discretionary should go a little bit higher because that means people have enough money to order out again. And people love going to Domino's or ordering from Domino's. We'll see if that's picked up. Then we've got Nucor, we've got a metal company, we've got Philip Morris cigarettes, and Travelers Insurance. Not a huge day, but a good overall day to find out where we stand. Keep your eye on airline stocks. Airline stocks is going to be really, really big. And again, we still have some bank stocks. Bank stocks, airline stocks, and a couple of odds and ends. Keep your eye on the insurance. Travelers, very important. This is what the EPS expectations are. So if the numbers are higher than this, you can expect a rally. If the number is lower than this, you can expect dovish behavior. And tomorrow we've got Twitter. And here's the expectations on Twitter. They're expecting 15 cents a share, and I think they're going to beat estimates on 23% higher revenue. I don't think they're going to beat revenue, but I think they're going to beat estimates. Now, let's talk a little bit about different sectors. Now, we've been seeing a major rally, and I think we're going to stall out before getting up to the resistance level, which is this area right here. This area right here on the chart. And if you notice, we've been really gearing up there. But the two sectors that are the closest to it, are healthcare, which has been kind of sagging because tech stocks have been rallying, and it's inverse. Look at consumer staples and healthcare. Look at how they look almost identical. Remember, these two sectors do well in an inflationary environment and in a recessionary environment, and they've been holding on. Even with tech rallying, they've been holding on. And now it's time to see if they rally and if these tech stocks come off a little bit. Now, communication sector is gearing up. Consumer discretionary is almost there. But again, not quite. And the question is going to be, are we going to get up there or are we going to cool off? That's the big question right now. That's the million-dollar question. Is technology and consumer discretionary going to get, for tech, it's the 142 level. For the consumer discretionary, it's the 156 level. They need to really break above these levels to start bringing a sunshine to the sector. Otherwise, they can just come right back down here and we're back in a downtrend or a choppy period, which wouldn't be the worst thing. That's what the bond market is showing us we're in right now. But it would be great to see if we can break out above these levels. I don't think we can, personally, not yet, which means more upside for consumer staples, healthcare, and possibly financial, but not so much for consumer discretionary. I want to be proven wrong, but that'll only happen if earnings continue to be a lot better than they are expected, and I don't think that's going to be the case. If I were you right now, I would stay defensive. Look, consumer staples is number 2 right here on a monthly basis, on a cumulative basis. On a monthly basis, it's in the middle. Healthcare is number 3 on a monthly basis, and on a cumulative basis, it's number 4. Honestly, I would stick with healthcare right now. You can't go wrong because there's still a lot of uncertainty with this market. And if you look at healthcare, look at how well it has, where's my healthcare? Look at how well it had withstood the last few days. It hasn't gone down. It's been going choppy, which means if we get some bearish sentiment on consumer stocks like tech, this could turn back around and market cap can go back in there. So I would stick with healthcare XLV. If you go to XLV, you will find, sorry, wrong sector, XLV, you will find that call options, if you go all the way to November, they're not that expensive. I would go with the 130 right here or the 131. And you don't have to go that far. You can go to October. Yeah, October's fine. Here you go. You can go to the 131, 130. You need to work these orders or go a little out or wait till the day ends. The spread will tighten till about 15, 20 cents, but I would wait till the end of the day and pick up the 130, 131 that's expiring in October, right around my birthday. I think we'll see more upside. Implied volatility is not high right now. It's lower than historic volatility, so you're not getting ripped off on the option. And remember today, folks, remember something very, very important. Due to the overwhelming positive feedback, I've decided to go live again today and open up a few more spots. We only opened up 25 spots in Pattern Trader. They sold out in like 5 minutes. And I got some letters saying, Roger, you got to take it easy with these 5-minute opening 25 spots. There was like 500 people in the room. So I'm going live today. I'm opening up a few more spots inside my biggest trading breakthrough of my entire career. At least that's what my traders and people in my VIP room are telling me. It's a brand new way to trade stocks without using any sort of fundamentals or technical indicators. And if you want to get in on the very first pattern trade, then I'm calling on you to join me at 1 p.m. Eastern Time. I'm releasing not 1, not 2, 3 brand new trade ideas on my Pattern Trader trade list, on my hit list. And I'm going to give it to you guys in a couple of hours. You guys don't want to miss it. You'll see the profit factor, the win rate. I'll even throw in the chart so you could see the historic accuracy of it. Don't miss this opportunity. Save this link and use it to enter the room before 1 p.m. to save your seat. We broke the internet last time. I was offline for 5 minutes. It was crazy. Anyhow, I'm back. I'll see you then. It's happening at 1 p.m. Eastern Time today. Do not miss out. 3 setups from my pattern hot list with over 70% win rate, profit factor over 2, and a win rate over 70%, I'm going to give them to you on the house. Our win rate so far has been 100%. And my assistant, Matt, he took 7 trades on his own and he had 7 winners in a row. That sly fox. Follow the link below. Check out Pattern Trader. And 1 p.m. Eastern time, I'll see you then. Don't be late. It's going to be a treat. I'll answer all your questions. We'll have a great time. Bye, guys. I'll see you soon.